Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Navigating Black Swan Events, what every investor needs to know. Imagine waking up to find the stock market in chaos, with investors scrambling to make sense of plummeting values. This scenario isn't just a nightmare, it's the reality of a black swan event. These are rare and unpredictable occurrences that can disrupt financial markets and upend investment strategies. Despite their low probability, black swan events carry high impact, leaving many investors unprepared. In this video, you'll discover what makes black swan events so elusive and why they matter to your financial future. We'll explore the nature of these events and offer insights to help investors anticipate and respond effectively. Understanding these extreme outliers could be key to deeper risk management and more resilient investment portfolios. Ready to see how you can stay ahead? Let's dive in. Defining black swan events. Black swan events are one of the most intriguing and challenging phenomena in the investment world. These events, which seem to arrive without warning, can have profound consequences on financial markets. To grasp their essence, let's dissect what makes black swan events stand out. Origins of the term. The term, black swan, was popularized by Nassim Nicholas Taleb in his book, The Black Swan, The Impact of the Highly Improbable. Taleb's work revolves around understanding the unpredictable and rare occurrences that shape our world. He describes a black swan as an event that lies outside the realm of regular expectations, holding the potential for massive consequence. Before discovering black swans in 17th century Australia, Europeans saw all swans as white, making the sighting of a black swan both shocking and enlightening. Taleb uses this metaphor to underscore how our understanding often rests on incorrect assumptions, leading us to underestimate the frequency and impact of such rare events. Characteristics of black swan events. Black swan events are not just extraordinary because they surprise us. They carry distinct features that set them apart from other market occurrences. Unpredictability. Black swan events strike without advance warning. As hard as investors may try, these events defy prediction through traditional risk management strategies. This unpredictability is what leaves many scrambling to react once such an event occurs. Massive impact. The aftermath of a black swan event is frequently monumental, reshaping entire markets or economies. These events have the power to bring down financial institutions, alter geopolitical landscapes, or prompt new regulatory measures. Their significant impact cannot be overstated. Rationalization after the fact. Once a black swan event unfolds, there's a natural tendency for analysts and investors to rationalize it in hindsight. This process makes the event seem almost predictable in retrospect, even though it was unforeseen. Our human nature compels us to find patterns and explanations, often minimizing the event's unforeseen nature. Understanding these characteristics can help investors prepare mentally and strategically for the unexpected, even if they can't foresee the event itself. Avoiding complacency and building flexible strategies can significantly reduce the damage when another black swan looms on the horizon. Historical examples of black swan events. Understanding historical black swan events can shed light on the unpredictable nature of financial markets. Let's explore 3 major events that took everyone by surprise, leaving lasting impacts on the global economy. The 2008 financial crisis. The 2008 financial crisis emerged from a perfect storm of risky financial products and lack of regulation. The housing bubble burst, rooted in predatory lending and aggressive mortgage-backed securities, which sent shockwaves through the financial system. Banks that took undue risks found themselves with toxic assets, leading to bankruptcies and bailouts. This crisis unfolded with staggering speed, illustrating the unpredictability of black swan events. It left behind a legacy of devastated economies and newly minted regulations, such as the Dodd-Frank Act, aimed at preventing a repeat. The effects. Millions lost jobs, homes, and financial security. It was a rude awakening to the pitfalls of chasing high returns without proper oversight. The dot-com bubble burst. In the late 1990s, the internet was the new frontier of investment opportunities. Companies with .com in their names attracted enormous valuations, often without any revenue. But in early 2000, reality set in. Stock prices plummeted, and countless tech companies went bust overnight. For investors, it was a tough lesson in the dangers of speculative investing based on hype rather than fundamentals. The market correction wiped out over $5 trillion in market value, but it also paved the way for sustainable growth and innovation in the tech sector. Who could have predicted that the promise of a digital future would swiftly collapse, leaving devastation in its wake? September 11 attacks and market reaction. The September 11 attacks in 2001 shocked the entire world, and the financial markets were no exception. The unprecedented and tragic event led to a staggering drop when markets reopened. Wall Street was paralyzed, with the Dow Jones Industrial Average plunging more than 600 points in a single day, the largest decline in history at that time. Investors couldn't have predicted the catastrophe, yet it highlighted the vulnerabilities of global markets to geopolitical events. The tragedy rewrote the rules of engagement in financial markets, emphasizing the need to consider external threats and investment strategies. Did anyone foresee how swiftly a single day could change the financial landscape? These Black Swan events, while devastating, serve as poignant reminders of the unpredictability in investing. They taught us the importance of being prepared for anything, even the unimaginable. The role of uncertainty in investing. Investing isn't just about numbers and trends, it's also about navigating the unknowns. Uncertainty looms over every financial decision, and Black Swan events amplify this unpredictability. Understanding how to handle this uncertainty can be pivotal for any investor looking to secure their financial future. Risk assessment and management. When investors try to gauge risk, they typically rely on models and historical data. These tools help predict market behaviors, but they aren't foolproof. Black Swan events, by their very nature, escape these traditional metrics. They don't fit neatly into any chart or graph. Over-reliance on models. Many investors depend too heavily on complex models that attempt to quantify risk. These models use past data to project future outcomes, but they cannot account for unprecedented events. This reliance can create a false sense of security. Limitations of diversification. While diversification spreads risk across various assets, it doesn't eliminate it. During a Black Swan event, correlations between assets can unexpectedly converge, leaving portfolios exposed to significant losses. Investors must recognize these limitations and adopt flexible strategies. Building resilience into an investment strategy often means preparing for what can't be measured or predicted. Behavioral finance perspectives. Human psychology plays a huge role in financial decisions, especially when faced with unexpected events. Black Swan events test investors' emotional resilience and often lead to knee-jerk reactions. Fear and panic. A sudden market downturn can trigger panic selling. Investors driven by fear often sell off assets at a loss, exacerbating their financial woes. Emotional decisions frequently lead to irrational market behavior, which can distort pricing and lead to further volatility. Overconfidence and denial. Conversely, some investors may downplay the severity of a Black Swan event, clinging to the belief that markets will self-correct quickly. This overconfidence can result in missed opportunities to mitigate losses or reposition portfolios. Understanding these psychological responses helps investors maintain clarity and composure. By anticipating emotional pitfalls, they can formulate a proactive plan that allows for calmer, more rational decisions under pressure. The road to investment success is paved not only with knowledge and analysis but also with emotional awareness and adaptability. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.